And I'm starting the webinar. Hi, everyone. As you are filtering in here, I will go ahead and introduce myself. We'll go over some housekeeping items, do some other quick introductions, and then we will jump in and get started. So thank you so much for joining us today. This is part 3, rates and sourcing of the 7 pillars of a successful sales tax strategy, broken into individual webinars and adding an 8th pillar, audit. So thank you for joining us so far. Please join us next week. We're going to do use tax, and then we will release the last 4 pillars in this new webinar series that we're doing. So let's go over some housekeeping items. If you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. We will need you to answer our poll questions as they pop up on your screen. If you have any issues with that, you can just send me a message and I will help you get that sorted out. We also will need you to fill out the survey at the end of this webinar. It will pop up for you automatically and it will be emailed to you in 24 hours along with the slides and handouts. And speaking of the slides and handouts, a couple other things that we want to make sure we cover here. First of all, if you have any questions as we are going along, please reach out and ask those questions. We're going to do our absolute best to address them at the end of this webinar or following up with you via email. Again, we're going to do our best to address those questions. Please use the Q&A button in the middle of your screen. If you move your mouse around, you'll find it. We also will be sending out today's slides in the chat feature. They will be uploaded to Zoom and emailed to you in 24 hours along with the handouts. So you will have multiple ways to get your hands on those. And let's do some quick introductions here. First, Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, and like our name states, more. So if you have questions about our services, please reach out and ask. We would love to answer those questions and we'd love to work with you. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded and he has helped thousands of companies of all sizes and in all industries and is especially well-known for his work in the e-commerce industry. So Mike, if you want to take it from here, let's go ahead and get started.
Absolutely, Ellie. Thank you for the wonderful introduction. And we've got a lot of information to cover today. Sometimes I hear, well, what do you mean a lot of information? How much information can there be about rates? It's actually a little bit more than that. We're going to go over sourcing today. And sourcing issues can have huge problems out there. I'll start off with a quick story. We had a client that come to us and they were out in California and, you know, this is quite a number of years ago. They got a contract with Blockbuster. So overnight they went from, you know, just working in California to working nationwide. And they didn't really do their homework. They didn't figure out where they had nexus and whether or not independent contractors created nexus for them. And they didn't know if what they were selling was taxable. So their accountant at the time came up with the bright idea of let's just charge a tax everywhere. And if we don't get any pushback, great. And we'll just remit it all to California. Well, state of Texas, they actually did have nexus there, and this is about 7 years into this. And state of Texas says, we see that you're collecting tax, but we're not seeing that you're remitting it. And Texas wanted their tax. You know, the sales should have been sourced to Texas, but instead, the taxpayer was sourcing them to California and turning in all of the tax to California. So when Texas says, hey, what is this tax? And Where is it? They said, oh, don't worry about it. We didn't know if it was taxable or not. So we decided to collect the tax just in case. And we turned it into California. So you can go ahead and call California and get it from them. And Texas sort of had a chuckle at that point. Man from Texas said, no, you can call California. We want the last 7 years back tax plus penalty and interest, and we want it now. So they had to pay taxes. In situations where tax has not been collected, you can go back to your customers and ask them for it, but they had already collected the tax from their customers. They just turned it into the wrong state, so they could not go back to their customers. And when they went back to California, California said, well, we can't give you the last 7 years. That's out of statute. We can only give you the last 3 years. So because they did not turn this into the right state, tax that had already been collected from their customers and paid, they had to come out of pocket for 4 years worth of that tax. So rates and sourcing do have a lot more than meets the eye sometimes. So today we're going to cover rates. We're going to cover sourcing. We're going to talk about origin versus destination. We're going to talk about the sourcing of digital property, and then we're going to talk about local rates, everyone's favorite topic. But before we do, let's start off with a quick polling question. Ellie?
Yeah, that should be up on everyone's screen right now, Mike. And I think, Mike, let's go ahead and turn off your camera. Your voice is perfect, but you are starting to lag a little bit here. The question we have is, we want to get a feel for who's in the audience. So you are here for the CPE credit to learn helpful information for your business. It's a requirement for the company you work for or other. And Mike, a lot of people here for helpful information, CPE credit, kind of answers across the board really, but why don't we leave this open a couple more seconds? Quick reminder again, you do have to answer these poll questions in order to receive CPE, and we will close this out and move forward.
Okay. Now, the biggest question we have when it comes to rates is, what rate should I use? And like I said before, it's not always an easy answer, especially if you're selling across multiple states. This map here, every different color, every different shape is an actual taxing jurisdiction. Now, I've never counted them personally. I've heard numbers from as low as 7,500 to as high as 15,000. The one number that we use is actually 13,000. So whether this is 7,500, 15,000, 13,000, any number in between, that's a lot of taxing jurisdictions. So figuring out which one of those taxing jurisdictions rates to use can be quite a chore. In order to answer the question of what rate to use, the first thing we need to do is to figure out where that sale is sourced. In other words, which jurisdiction has the right to tax the sale? Now, today we're going to look at the sourcing of tangible personal property, the sourcing of services, and the sourcing of digital property. We'll look at the states first and the local jurisdictions later on. Before we do, let's talk about origin versus destination sourcing. And way too much of a focus on this by the software companies, to the point where I've had people tell me, Mike, I'm in an origin state, so therefore I don't have to worry about paying taxes to any other state. Now, that's not the way that that works. Origin uses the address of the seller's business, but it only impacts local taxes. All right. When we're talking about interstate sales that cross a state line, we're almost, at least for tangible personal property, we're almost always going to use destination sourcing. And destination uses the address of the customer. So origin is for really intrastate sales, a sale that never crosses the state border. And like I said, it impacts only the state, the local taxes within that state, if there are. So we said we're going to start with the sourcing of tangible personal property. States generally base their sourcing rules for tangible personal property on where the purchaser or their representative takes possession. Now, usually that's going to be in the ship to or the delivery state. However, there are exceptions to that. Someone can use their own trucks and come pick up from you, and therefore they're taking possession at your loading dock. So it's where the customer or the representative takes possession, and that's usually going to be the ship to or the delivery state. Incoterms, they're generally ignored. In most instances, the ship to or delivery address, as we've been saying, is where it's going to take. It doesn't matter where title or risk of loss passes in a lot of situations. It doesn't matter who has ordered the shipping. So the default is it's going to be the ship to a delivery address, unless someone is picking up in their own trucks, or they're picking up with someone other than a common carrier. So states generally base their sourcing rules for tangible personal property. We've said this already. Here's something that's important. Common carriers generally not considered representatives. So if a common carrier is being used, you still use the ship to or the delivery address, wherever the purchases has said to ship that. In most instances, the ship to a delivery address is where the tangible personal property should be addressed. So we touched on this a little bit. Exceptions to the ship to address: if a purchaser or the representative picks up in their own trucks or uses a private contract carrier, then the sale is generally sourced to the pickup location. It's where the purchaser is deemed to have taken possession. All right, so what is a common carrier? You've heard me use that a couple of times so far. Common carrier is a person or commercial enterprise that transports passengers or goods for a fee and establishes that that service is open to the general public. So some common examples would include a ship owner, railroad, airline, taxi service, etc. A private carrier, on the other hand, is a person or commercial enterprise that only agrees in particular circumstances to transport passengers or goods. Private carriers differ from common carriers because they don't establish that their service is open to the general public. In other words, private carriers enter into a contract with each customer without the assumption that a similar contract will be available to the next customer. And that's going to be very important in determining where you source a sale. Is this being delivered by a common carrier or a private contract carrier? So let's look at some TPP examples. In example number one, the customer is in state A, and they place an order with the seller in state B. The seller has a common carrier deliver the TPP to the customer in state A. And in this example, fairly easy one, very straightforward, the sale is actually sourced to state A. That's the delivery state. In example number two, a customer in state A places an order with the seller in state B. The customer arranges and pays for a common carrier to pick up from the seller in state B and deliver to a different location in state C. Well, the sale is sourced to state C, again, the delivery state. Doesn't matter who pays for the common carrier. Common carrier is still going to usually be or generally going to be sourced to the delivery state. Some further examples. A customer in state A places an order with the seller in state B. Customer sends their own truck to pick up from the seller in state B and deliver to a different location in state C. Well, in this one, the sale is sourced to state B. It's where the customer picks up because that, since they're using their own trucks, that is where the purchaser is taking possession. So remember, wherever the purchaser is taking possession is going to be where the sale is generally sourced. If they're picking up in their own trucks, or they're using some sort of agent to pick up on their behalf, then that's going to be at the pickup location. Otherwise, it's generally going to be at the delivery location. We saw previously that when the seller ordered a common carrier and they paid for it and ordered for it, it was still at the delivery state. This is the exception to that, when they actually pick up in their own truck or have an agent pick up. And again, common carriers are generally not agents. All right, so the next example, customer in state A places an order with the seller in state B, and the customer's representative in state D sends a contract carrier to pick up from the seller in state B and deliver to an entirely different location in state C. Well, again, we have to look at where the seller or an agent, a representative of the seller, where do they take possession? And in this case, it was state B at the seller's docks or warehouse or wherever. So again, this sale is sourced to state B. Ellie, why don't we go on to the next polling question?
Absolutely. That question should be up on everyone's screen. It's a true or false question. Origin sourcing uses the address of the seller's business, true or false. And quick reminder for everyone, you do have to answer these poll questions in order to receive CPE credit. We'll leave this open a few more seconds here. Answers are still rolling in pretty quick, Mike. Most people are answering true. If we want to review this quickly, and then we can move forward.
All right, so origin sourcing does use the address of the seller's business. What's important to remember about origin sourcing is it's only for intrastate sales, and it only impacts which jurisdiction's local rate should we use. And more states are going to a destination basis or a modified origin basis rather than a pure origin basis. All right, so what about services? Well, for sales and use tax purposes, services are generally sourced to one of the following: where the service is performed, where the benefit is received, and those are often the same place, and the customer's principal place of business. So it depends on the type of service and it depends on the state. So sometimes, as I just mentioned, it can be the same state, but two different types of services. And the state can have different rules for different services. And sometimes it's fairly easy to determine the sourcing of a service, and sometimes not so much. So let's look at Connecticut. And with some services, as we said, it's easy. For example, landscaping, pool cleaning, pet grooming, health and athletic club services, janitorial services, babysitting. All of these places, the benefit is generally received in the same place where the service is offered. So, babysitting, wherever the baby's located, that's where the service is going to be sourced. Hair weaving, it's going to be sourced to the beauty salon that you go to. So these are all, fairly easy to determine. And by the way, these are all services that Connecticut does tax. A lot of people don't realize the breadth of services that get taxed in different states. And they're going by what they know in their home state. And now if we offer services in different states across the country, then that's when we get in trouble, because we don't realize how many states tax so many more services or different services than the services that are taxed in our home state. So here's one not so clear. This is for employment services, and the hiring company is outside of Connecticut in state A. The employment agency is outside of Connecticut in state B. The candidates are all outside of Connecticut in states A, B, C, and D. And the job to be filled, they're all in Connecticut. So this service is going to be sourced to Connecticut because Connecticut believes that the benefit is received in Connecticut because that's where the jobs that are going to be filled. So sometimes it's not so clear where to source this. I mean, I could make an argument that it would be in state A because that's where the hiring company is, or, in state B because that's where the employment agency is, or where the actual candidates are from. But Connecticut is going to look at where the job is, the job to be filled. And in this instance, it's in Connecticut. So that's where they would consider this service sourced. Now, Texas service sourcing it can be different. For information services and credit processing services, if the work is performed in Texas and the customer is in Texas, then the sale is sourced to Texas. Pretty easy. If the service is used to support a separate and identifiable segment of the business, well, wherever that segment of the business is located, that's where the sale is going to be sourced. And if the service cannot be assigned to an identifiable segment, then the service is presumed to be used in support of the general administration at the customer's principal place of business. So it can get pretty complicated in trying to figure out where your sale is actually going to be sourced. Here's a case study. This was actually a research project that one of our clients asked us to perform. They had a pretty tricky situation. And the company was located in New York, and they hired a detective agency in New Jersey. And detective agency had an employee in Texas. In this instance, they were the one who did all of the work. But the work was actually done in Minnesota, and that's where the subject lives. And they were trying to some type of insurance work. They thought this person was committing insurance fraud, and the insurance agency up in New York, wanted to catch this person doing things they were not supposed to be doing. So the subject lived in Minnesota. That's why most of the work was done there. Now, we said the employee of the New Jersey agency lived in Texas. So when they got back to Texas, a report was created in Texas, and then the report was delivered to the New York company. Now, where's the benefit received here? I mean, again, we can make arguments that it was Minnesota, or we could say Texas, we could say New Jersey, but the benefits actually received in New York. It's where the customer ordered it. But more importantly, it's where the report was delivered and used. So that New York company took that report and they used it in New York, and that's where the benefit was received. And it just so happens protective and detective services are actually taxable in New York. They're also taxable in some of these other states, especially New Jersey. So It could have been taxable in a number of places, but New York is where it should have been sourced, and the tax that is collected should have been the New York tax. All right, so what about digital property? How do we source that? Well, digital property is generally sourced using a hierarchy of knowledge known at the time of sale. Now, not all states use the exact same hierarchy, but they are similar. So on the next slide, it's going to be a sample hierarchy language, and we'll go through it. Now, it's important to note that when using a hierarchy, you cannot manipulate it in order to provide the result you want. That constitutes bad faith. In other words, you're committing fraud, and the states do not look kindly on that at all. So you can't manipulate this. You can't say, oh, well, this one works better for me. It's not taxable here, so I'm going to use that one. You gotta, follow this hierarchy truthfully and honestly if you want to stay in compliance, if you don't want to be stepping outside the lines and getting yourself in trouble. So the first thing is at the business location of the seller. Sometimes someone may download something while they're in the physical location of a business. And if that's the case, then that's the address that you use. Now, the second one is if I tell you that I'm going to be using it in this location, that's where you're going to source it. If I tell you where. Now, again, you have to be honest. You can't say I'm going to use this in Oregon and there's no sales tax in Oregon when you're really going to be using it in the state of Washington, and it would be taxable in the state of Washington. So you got to be honest. You got to, believe that that's where your customers actually going to use it, where they're telling you they're going to use it. Number three, when 1 and 2 are not applicable, then you go to an address in your books and records. If you have repeat customers, you probably have their information in there, and whatever it says, that would be the third thing you would go to. Now, a lot of times, especially when we're talking about online sellers, you don't have any of those first three things. And when they're inapplicable, then you go to an address, and this is often the default that a lot of online sellers go to, an address that's received at the time of sale. In other words, if someone's buying something online, they're very often going to be using some type of credit card. And usually you have to enter in an address or something in order to, verify the credit card. That's an address that is often used during this whole process. And when the first 4 are inapplicable, you go to number 5, and I would not suggest this. You usually can get something out of the first 4, but number 5 says the location will be determined on the address from which the digital good was first available for transmission by the seller, which could be the same as number 1. Could be, might not be, might be different locations. But I would not go that far unless I absolutely have to. Generally, the catch-all is number 4 if you can't get one of the first 3. So as I was saying, most common results, number 2, if the seller tells you it will be downloaded, or if your technology can determine. Sometimes we know where something's being downloaded. That is where it's going to be sourced. Number 3, an address located in your books and records for the purchaser. Repeat customers would be a great example because you already have that information. And then number 4, an address obtained during the sales transaction, like a billing address for a credit card. Now, every time I do this slide, someone says, well, what about number 1? Well, that's not a most common result. What we're looking at are the numbers from this page here. So the ones used most often are 2, 3, and 4. And 4 by far is the one most often utilized. Ellie, want to go to the next poll question?
Yeah, absolutely. That should be up on everyone's screen right now. Quick reminder to everyone that you do have to answer these poll questions in order to receive CPE credit. We have a little bit of a quiz for you. So for sales and use tax purposes, services are generally sourced to one of the following, except please choose the answer that does not belong. So where the service is performed, where the benefit is received, the customer's principal place of business, or wherever the person paying taxes wants. It looks like we have some typos in here, so I apologize, but pretend that it says wherever the person paying taxes wants here. So Mike, most people are nailing this question. Let's review it really quick and then we can close it out and move forward.
All right, so this is one of those negative questions. Which answer should not belong here? And the first three, they actually could be places where you would tax. And the fourth one is generally not. You generally have to, wherever the service is being performed, wherever the benefit is being received, or the customer's principal place of business is generally where you're going to source something, not where they tell you that they want, not when we're talking about services. So got a smart group here. All right, so let's continue with rates, and we're going to be moving on to local rates now. And historically speaking, there were a couple of factors that could influence whether a local rate was charged. Wasn't always charged. And some of these factors were, was the sale interstate or intrastate? And the second is, what type of registration did you do? Did you do a sales tax or did you do a seller's use tax? Which state was involved? And the time period, are we talking about before 1977? Or are we talking after 1977? Or are we talking about after 2018? And the reason why this is important, because prior to 1977, intrastate sales were generally considered a sales tax. All right. Technically, all sales that crossed the state line were considered a sales tax, and sales that, excuse me, I said that backwards. Intrastate sales, sales that never crossed the state line, were considered a sales tax. And if it did cross the state line, then it was considered a vendor's use tax or a retailer's use tax or a seller's use tax. In 1977, we had complete auto transit, and complete auto transit saw the blurring of the lines. And what complete auto transit said was a U.S. Supreme Court case, and it basically said that yes, states had the right to tax interstate commerce directly. So the reason we had a use tax was because prior, to 1977, actually prior to the 1950s, we even the states didn't believe you could tax interstate commerce directly. So the use tax came about, and it was for the storage, use, or consumption of a product inside of a state. So it wasn't a tax on the transaction itself. It was a tax on how that product was being used. So it was word games, but that's how they got around it. Because if you had nexus in a state as the seller, you still had a responsibility to collect this tax. And the reason why the states did this is because we had companies setting up right on the border of a state. And maybe you had, two stores 500 yards apart. One of them was forced to collect the sales tax and one of them was not. And, the states that imposed the sales tax, all of a sudden, they were hurting their in-state sellers. because people would just walk across the state line and buy it across the state. So that's why they tried to level the playing field by, starting to impose these these use taxes. Um, so that started to blur in 1977. We had states like Pennsylvania do away with their seller's use tax. And when you register in a state like Pennsylvania, you register for the sales, use, and hotel occupancy. It's just one registration. But there were other states like Colorado and Illinois and California and Virginia, where they still had different types of taxes. And if you were an out-of-state seller with no physical location, you generally signed up for the use tax, and the sales tax was only if you had brick and mortar location inside of the state. Now, Wayfair comes along and we see a big change again, because a lot of states are saying, okay, you were signed up for the use tax, but now that Wayfair's passed, you've got to switch and you've got to register for our sales tax. Now, the reason why, when you were registered just for the use tax, there was not a requirement to collect the local rates like the retailer's use tax in Illinois. You only collected the state rate. In Colorado, the seller's use tax, you only collected the state rate. In Missouri, the use tax, only the state rate was collected. And now a state like Illinois comes along and they say, okay, you now have to collect the retailer's occupation tax. Colorado was the same way. They said you now have to collect all of the local jurisdictions. You got to be registered for the sales tax. So it's important when we look at this, when we look at local rates, how are we registered? And the state will dictate how you need to register depending on what your facts and circumstances are. We'll come to that in a minute. Let's talk about the states of Connecticut. DC is not a state, but when we're talking about sales tax, it's often treated like a state. Indiana, Kentucky, Maryland, Massachusetts, Michigan, New Jersey, and Rhode Island. Those states are pretty easy because they do not have local rates. So you just have the state rate in those jurisdictions that I just talked about. The average local rate, when we're looking at all the local rates across the country, is 1.5%. However, that's going to be very misleading. And in some states, the local rates may be as high as 9.75%. Alabama, Colorado, and Louisiana have some of the highest local rates out there, with average rates of 5.22, 4.82, and 5.07 respectively. And that is before we saw the last round of rates going up. In some of these jurisdictions, like in Colorado, the local rates are often much higher than the state rates. So you got to be careful. And if you have a responsibility to collect the local rates, you want to make sure you're collecting the right amount. Local taxes can include the county, the city, the district, and any other special taxes that can be lumped in there. And they're generally shown as a single rate, but they are comprised of different rates across the board. Now, some states will cap them. A state like Texas has a 2% cap. So the don't hold me to that. I've got to go back and check on that. But anyway, the maximum rate in Texas right now is going to be 8.25, whereas the state rate is 6%. So that would be 2.25, not 2%. So if there's a hierarchy and, it goes down the hierarchy. And if you're the last one, say that you are the a special tax or district tax, then you don't get to charge your full rate if it doesn't fit within that cap. All right, so most states have moved to destination sourcing to determine local sourcing, but some states still use origin-based sourcing on interstate sales, intra-state sales. And then some states use a modified origin. And modified origin often has different rules for different scenarios. So we're going to look at Illinois and Texas. Illinois is a problem. We'll go through why it's a problem. Scenario number one, company has a physical presence from which deliveries are made in the state. In that scenario, the seller needs to sign up for the retailer's occupation tax, or that's what they call their sales tax, the retailer's occupation tax, or ROT. And they need to collect based on the ship from location. And this is going to be origin. Now, scenario number two, company is a remote seller and ships into the state. So they have no connection in the state whatsoever. No nexus, except for an economic nexus. Well, the seller needs to sign up for the retailer's occupation tax. Again, that's their sales tax, but they need to collect based upon destination. There are almost 4,000 jurisdictions in Illinois. So you've got to have almost 4,000 different rates. And not only that, when you go to do your return, it's a nightmare because you have to account for each one of these jurisdictions separately. We had to hire 3 extra people just to handle the state of Illinois. The software we're using wasn't being updated. They didn't have any plans to do it. It actually caused us to change providers, but we had to hire, 3 people just to handle Illinois for this. Now, does that sound fair? Does it sound fair that if I have a location there, that I only have to worry about one rate and my return is very easy? All I have to do is worry about the origin? No, to me, that doesn't sound fair at all. And I think almost certainly this is going to be challenged on a constitutional basis. And we'll look at that a little bit more on the next slide. So scenario 3, company has a physical nexus in Illinois, but no inventory. Well, this seller gets to register just for the retailer's use tax and does not collect local taxes at all. So here's a planning point. We tell a lot of our clients that are pure economic nexus, they don't have any, reason to go into Illinois, hire someone either in Illinois or just send one of your existing salespeople or employees into Illinois a couple times a year, create some nexus in Illinois, because now all you have to do is collect those state taxes. You do not have to collect the local taxes, and that's going to make it a lot easier on yourself or whoever is actually doing the returns for you. So what's the big deal about Illinois in their local taxes, the way they're doing it now? Well, we mentioned complete auto transit, and that's the test for whether a tax is constitutional or not. They've got a 4-prong test, and one of the prongs is it discriminates against interstate commerce. So if I have an in-state company that only has to worry about one location and an out-of-state company that has to worry about 4,000 locations, to me, they're discriminating against the out-of-state company. I think this is pretty clear. It violates the 4-prong test of complete auto transit, and it's just a matter of time, I think, before someone challenges this. Now, every time I say that, someone says, well, Mike, we'll just not pay attention. Well, number one, Illinois is aggressively enforcing this right now. So that's number one. And number two, it's real easy for Illinois to fix this and sometimes go back retroactively. So I would not use this is unconstitutional and I'm not going to collect it because you may end up in a pickle later on. So I still think that we need to comply. Number one, because Illinois is being so aggressive. And number two, because when they do get their hand slapped and say this is unconstitutional, it's a real easy fix. They just make everybody go to destination basing, or you know, uh, that's one of the easiest ways to do it. So um, it's a no-win situation, but it is a problem. All right, so let's look at Texas local sourcing. On interstate sales, Texas generally looks to the location where the order was first accepted if it's an in-person sale. All right, so if I go into someone's business location, then an order from there, it's where the order was first accepted, especially if someone has multiple locations. Now, here's the problem. What's the definition of a business location? Well, in Texas, the definition of a business location is a place where at least 3 orders a year are accepted. So if you have a warehouse in Texas, that's generally not going to be considered a business location. It's got to be an office where orders are usually or generally accepted. All right, so for orders not placed in person, the sale is usually sourced to the location from which the order will ship. So you may have a warehouse, which is different from the place of business. In this instance, it's going to, be sourced to the warehouse. If the order is not shipping from Texas, it goes back to where the order was accepted. So if you have someone call in and you've got a sales office in Texas, but you're not going to ship the order from Texas, you're going to ship the order from Oklahoma, then it goes back to where that order was accepted, which would be that sales office in Texas. If the order was received outside of Texas, then destination shipping is used. So if someone calls the Oklahoma office, they give the Oklahoma office the order and it's being shipped into Texas, then destination shipping is used. So this modified origin, can have multiple rules, and it can be, very easy to get confused. Most of the companies that I know have a cheat sheet. And, in all the places where they can accept orders, people know what rules they're supposed to follow. All right, so how to figure out the rate? Well, I'm not a great fan of software companies. I think that they're a necessary evil. However, one of the things that they do well is figure out the rates. They can't figure out taxability well, but once you figure out how you're taxable, they can, keep you in compliance going forward. They can't tell Nexus very well, but they can act as a red flag that you can then jump on top of it. Which the software companies get themselves in real trouble is when they start trying to do services, because software companies are software companies that happen to be in the sales tax business. They're not really sales tax companies, and they get so many taxpayers in trouble by providing incorrect information or by having their customer pay an inordinate amount of fees for something that they don't need. When it comes to rates, though, There's so many rates out there. This is one area that I see the software companies doing very well. Automation is something that you can do. Sometimes if you have a very limited number of sales, some of our clients have, 6, 7 sales a month, but each one of those sales $2 or $3 million. You can call the state if you only have 6 or 7, sales, or a lot of the websites have places where you can check the state website and plug in an address and get the actual rate. Again, if you have some a limited number of sales, there are free rate lookouts up there, and you can type in the address and the get the full rate for both the state and local jurisdictions. And then sometimes your accounting platform or ERP cannot connect with one of these software companies, and it would cost more to build out a connection. Maybe you have a legacy system, maybe you have a homegrown system, and it would cost more to build the connection than it would for the software. And for those companies, if you can use, some type of Excel format or CSV format, there are companies that provide rate tables, and they can be used. And then again, we've been talking about the automation. All right, so Ellie, let's go to our final polling question.
Yeah, that should be up on everyone's screen right now. The hardest quiz of all. Will you be joining us for next week's webinar, Use Tax, the fourth pillar in a successful sales tax strategy? Your choices are yes, you can't wait, or you're going to try your best. Most people seem very excited. And again, we are super excited to have everyone as part of this new series here. We appreciate you attending all of our webinars. We appreciate the feedback that comes from those. And thank you for looking out for next week's webinar. There will be a link to register for that directly in your follow-up email that you will receive in 24 hours. So Mike, I don't see any questions right now. Anything else you want to add in here before we close out?
Just solicit questions. Does anyone have any questions? And as we get deeper into this series of new webinars, we will get smoother. So we appreciate y'all saying that you'll be coming to additional webinars. And if you do have any suggestions for what you believe would be a good webinar, please let us know, and we'll see what we can do about putting it together. And thank you, everyone, for coming today.
Yeah, thanks everyone so much. And again, please reach out if you have questions about our services or would like to work with us. And we will see everyone next week.
Thank you, everyone. Bye-bye.